Fractional reserve banking.
Fractional banking is a financial system where banks retain only a portion of their deposits as reserves, using the remaining funds to provide loans and earn interest. This system enables banks to act as intermediaries between savers and borrowers, facilitating economic activity while maintaining liquidity for withdrawal needs. Under fractional reserve banking, banks are required to hold a minimum percentage of deposits, termed reserve requirements, as either cash in their vaults or balances with the central bank.
For example, in the US, the Federal Reserve traditionally mandated a 10% reserve ratio on transaction accounts, though this requirement has been reduced to zero in recent years to stimulate economic growth.
These requirements help central banks regulate monetary policy by adjusting liquidity in the economy. The origins of fractional banking trace back to the gold trading era, when Goldsmiths issued promissory notes against deposited coins, realizing that not all depositors would withdraw their holdings simultaneously. Over time, Goldsmiths began issuing loans against these reserves, evolving into modern banking practices. This shift necessitated government intervention to establish regulatory frameworks, including the creation of central banks to oversee financial stability and prevent insolvency during bank runs.
Countries vary in their approach to reserve requirements.
While some, like the US, impose specific ratios, others such as Canada and the UK rely on capital requirements and central bank support to maintain stability. In the US, excess reserves, funds held beyond the required minimum, have been incentivized through interest payments by the Federal Reserve since 2008. The fractional reserve system significantly impacts money creation through the money multiplier effect. This theoretical concept estimates the potential expansion of the money supply by dividing the initial deposit by the reserve requirement. For instance, a $500 million deposit with a 10% reserve requirement could theoretically expand to $5 billion. However, this calculation represents the potential effect rather than the actual money created. Fractional banking balances the dual objectives of enabling credit expansion and ensuring depositor liquidity, playing a pivotal role in modern financial systems.